Hi everyone, welcome back to the channel. Continuing on with my real estate theme for the past few weeks, I'm going to be talking about REITs versus real estate, discussing the similarities, differences, whether you should invest in either, neither, or both. Please thumbs up the video and subscribe to the channel. Remember to turn on the notification bell so you get a little ring every time I release a new video. If you haven't yet, please check out my previous video introducing REITs or real estate investment trusts to get a little basic knowledge before jumping into this video. I've seen a lot of articles and videos talking about which one is better, which one you should choose, which one makes more money. I think people have been going about it the wrong way. I have a different take. I hope this provides a little bit of different information and different perspective as someone who has invested in and is currently invested in both REITs and real estate. Apologies for repeating some of the points of the previous video, but people invest in REITs because low cost to entry. Some REITs are only $20 a share. Wide variety of REITs to choose from, which have varying types of the underlying asset being purchased, like malls, healthcare, office buildings, and apartments. Less hassle of managing a real tenant, less hassle of managing your own property, and liquidity. You can buy and sell your investment, your shares at any time you want, granted within the trading hours with just a click of a few buttons on your phone. Now, quickly going over the benefits of directly investing in real estate. A lot of these are more qualitative, meaning not financial or numbers based, it's a lot more emotion based. Like direct control of your own investment. A lot of people would like the freedom and the ability to choose their own house, choose the location, choose their own tenants to lease to, and the decision whether to upgrade the unit or not. Some people like to see what they're investing in. They like to see their property. They need something tangible. This is a non-issue for me. I'm okay with stocks being purely online, but if this helps you sleep at night, like it helps you mentally, then go for it. The last intangible, I think people like the fact that you can live in this unit, this investment you've purchased, should you so choose. You can't go to a REIT, knock on the CEO's door and say, hey, lost my job, I need my share of units now, I'd like to live here. It just doesn't work that way. It's just a minor benefit, I guess. We discussed some of the qualitative benefits of real estate. Now let's talk about the quantitative, the financial-based decisions. There are tax benefits, writing off expenses you incur to earn your rental income. It'll reduce your taxes payable, kind of helping you with cash flow at the end of the year. The biggest benefit, I think a lot of people will agree on, and one that all these articles and videos are conveniently choosing to ignore, like I'll show you one in a minute, is leverage. They ignore the capital appreciation and potential financial benefits you get through leverage. Leverage is when you borrow funds to purchase an investment, either to A, purchase the investment in the first place, because who has 100% of the funds to buy a house? Even if you did, it probably wouldn't be the best idea to put all your eggs in one basket, and B, to increase the potential profit from your investment. I feel like everyone conveniently chooses to ignore while making their arguments the leverage factor and the potential magnifying effects it has on your profits when investing in real estate. Let's take a look at this Forbes Billionaire article. I'll place a link for reference so you could check it out on your own, titled "Data Proves REITs Are Better Than Buying Real Estate." Okay, what are you referring to? Let's go through the numbers. From 1977 to 2010, REITs have returned 12% annually, while real estate returned 6 to 8%. Then over the past 5 years, REITs have averaged 9%, while real estate is at or below 8%. Fine, that's all fine. Those are the numbers. Numbers don't lie. But why are they conveniently choosing to ignore leverage? The potential gains you have, cash on hand once you sell, taking into account borrowing money to invest in real estate. If real estate is growing at 8% a year and you purchase a $700,000 house, you're making 8% on $700,000. I'm pretty sure no one is investing directly, I think $700,000 directly in REITs to do an apples to apples comparison. Don't get me wrong, I'm not going to forget about margin. You can invest in stocks on margin. Some places like, some brokers like Questrade do a 3-to-1 margin ratio. Margin in this term, to put simply, is just when you borrow to invest in stocks. But if you take a look at the rate Questrade is offering, or even if you look at another broker, let's say TD Web Broker, the rate for Questrade right now that I'm getting is 6.95%. I went on margin for a few days last month when there was a timing delay between transferring funds from my TD account to Questrade. Went on margin, and the rate they charged me for a few days, they charged me annually 6.95%, prorated for those few days. If you take a look at mortgage rates for investing in real estate, they're averaging 2 to 4%. I think worst case scenario, if you have terrible credit or something goes wrong, you might get 5%. Let's take a look at the March 2020 year-over-year changes for a few cities. Let's go Vancouver, Calgary, Edmonton, and Montreal. These numbers came from a CREA report, Canadian Real Estate Association. I'll include a link for reference. For some reason, the Canadian Real Estate Association doesn't have April numbers as of the making of this video, even though it's in April, since this is the most up-to-date I have on hand. 2.1% increase in Vancouver, 11.3% increase in Montreal. If you put 10% down, this means you're leveraging the remaining 90%. So let's run through some numbers. You're making, what is it? If you have purchased an investment in either city for $700,000 with 10% down, you're making $14,700 in Vancouver and $79,100 in Montreal. With only a $70,000 investment, you would have had a 21% gain and a 110% gain in 1 year, respectively. Granted, this doesn't take into account closing costs, which is typically 1 or 2% of the purchase price, but let's be honest, that wouldn't make the numbers that much worse. Here's the flip side of leverage. Calgary and Edmonton, they've decreased year over year. Calgary is down 0.8% and Edmonton is down 1.3%. Since leverage amplifies your gains, it also has the ability to amplify your losses. So a $700,000 house in either city would be a $5,600 loss and a $9,100 loss, which are 8% and 13% respectively. So now you're thinking, if I had the funds 1 year ago, if I was to invest in something, I would have been better off buying REITs. The leverage factor and the potential amplification of your losses is a risk you're not willing to take. But then we also need to take a look at the 1 year increase or decrease for REITs for, let's say, the same period. You shouldn't really use 1 year intervals for determining the value of investments, whether it's good or bad. It doesn't take into account enough time. It doesn't factor in enough time for market corrections. Should there be a sharp decrease, sharp decline like we're at right now? But humor me just for a minute and just look and use this example if someone quickly claims that REITs have always been better. Let's take a look at VRE. It is a REIT ETF. Over 1 year, down 25%. Let's start picking random REIT stocks as well, starting with Brookfield, BPY, down 53%. Let's take a look at Smart REIT, down 41%. Let's look at Boardwalk REIT, down 33%. Isn't it weird? REITs are supposed to be tracking real estate. That's why you're investing in it. One of the benefits that everyone's mentioning, even I do, is that you're indirectly investing in real estate. But real estate prices, if you just take a look at the article I posted a few minutes ago, they haven't declined by 30 to 50%. That's because REITs behave more like stocks than they do real estate. And by that, for this purpose, I'm using, in terms of volatility, the ability to panic sell. This might be a serious negative or downfall for some investors, the ability to panic sell. They see the stock market tanking, they're afraid, they don't know what to do, it's their first time being in a recession, investing in a recession. You can quickly and easily hit sell on your phone, ensuring you have a loss. Whereas you don't have the same ability when you're directly investing in real estate, mainly due to the long and drawn out process of selling and closing a unit. I want to switch the conversation entirely. I don't think the question should be which one provides me with more money. They both provide cash flow. They're both proven to have gains over the long term. Also, one could be better depending on which conveniently chosen time window you choose. You can influence and skew the data to prove which method provides more money. Don't look at this poor 1 year comparison I just showed. I just want to use it as an example of how I personally don't consider REITs to be tracking real estate. Regardless, I think the decision you should be making should relate to whether you want to be more active or passive in your investment. Do I want something more physical or something intangible? Is my time more valuable to me than the potential gains? Is the stress or headache of managing my own property not worth the extra income I would get due to the leverage factor? Do I even have the cash or mortgage ability to directly invest in real estate? Those are the questions you should be asking, and hopefully these are the questions I'll try to be focused on answering in the remaining parts of this video. For many people, their time is more valuable to them, so investing in a REIT is better than investing in real estate. For real estate, you need to find a realtor, find the unit, find the tenants, and then there's the time needed for the ongoing management of that property for as long as you hold it. With a REIT, it's more passive. You can employ a set it and forget it style of investing that a lot of people like to do, and you can see your dividends, your cash come in on the 15th or 16th of every month. A major barrier to real estate is the cost. Can you afford to put $50,000 down? This might be your entire portfolio into a single investment. This is the deciding factor in many cases. Can you afford it? And if you can't, is it smart to put that much into one asset? Let me make another point. I completely disagree that investing in a REIT is considered diversification in your portfolio. Many people like to make the argument that you should avoid real estate and invest in REITs so you're more diversified. But I disagree. If you have a portfolio and you buy 5 different types of REITs, you've invested in 5 different types of the same underlying product, underlying asset, which is real estate. Buying 5 different types of REITs is not considered diversification. According to a book I've read and many investors have read, The Intelligent Investor by Benjamin Graham, diversification means you're investing in stocks and bonds. And within stocks, you're investing in healthcare, tech, finance, real estate, growth stocks, dividend stocks. If you're buying 5 different types of oil stocks, you're diversified in oil. You're not diversified overall. So I'm not buying that argument. For me to sit here and tell everyone which one is definitively better to invest in, it's not going to work. This decision is made purely case by case, investor by investor. Don't focus on the maximum amount of ROI you can get. If you decide that the max ROI is real estate, but then you hate the active involvement in managing and investing in real estate, then I wouldn't recommend it. Sometimes you shouldn't focus on the max ROI if it causes you to lose sleep, stress, or personal time, or valuable time with your family. So to sum up this video or tie it up in a nice little bow, I hate fence sitters. I hate saying do this if you want to do that. Let me give my answer. Let's say what I've done. Invest in REITs at the beginning of your career while you're in your investing career while your portfolio is growing. Then later on, when you have a big enough portfolio, you're diversified, you have enough capital, then dive into real estate. For more information on how to invest in real estate, check out my 2 previous videos, one being how to find a cash flow positive property in the Greater Toronto area, and the other being the 8 steps needed to take to buy your first investment property in Canada. Apologies for going so hard on Toronto, for focusing so hard on the GTA. I'd be doing a disservice. I'd be lying if I said I knew where to invest in Alberta, BC, or Quebec. I think I've gone hard enough on real estate in the past few videos on my channel. The next few videos, hopefully, I'm going to be focusing on stocks, stock market, and passive income investing. See you then.